Hey, y'all, Lisa Davis here, the trusted banker, and I am about to talk to you about FDIC banks versus credit unions to help you understand the differences between the two so that you can understand and make a good choice of which ones you should pick for yourself and your specific situation. So let's go. Okay, so let's look at it. Let's look at the agenda. So we're going to be talking about today differences and similarities between the FDIC insured banks and the NCUA insured credit unions. We're going to talk about the key features of each institution. We're going to talk about the pros and the cons that'll help you decide. We're going to talk about strategies to safeguard your money in uncertain economic times. So let's get to it. So first, let's talk about the FDIC, the Federal Deposit of Insurance Corporation. So this is an independent agency in the United States government, and it is not owned by a private company. The FDIC is an independent regulatory agency that has regulatory oversight over financial institutions that are chartered to have FDIC insurance. So the FDIC was established by Congress in 1933 to protect bank depositors' money, meaning that if you deposit money into a bank, the FDIC, that insurance, protects your money up to $250,000. The FDIC is funded by premiums collected from member banks and savings associations. The FDIC is funded by premiums collected by member banks and saving associations. And the FDIC uses the premiums to pay for operating costs and to compensate depositors of failed banks. The FDIC is backed by the Federal Reserve, which can lend the FDIC up to $500 billion from the. So now let's look at the overview of insured banks. The key features, the profit motive. For-profit institutions, the banks that are insured are for-profit institutions aiming to generate returns for the shareholders. The range of services that insured banks are financial institutions, banks, your Chase, your Wells Fargo, your Huntington banks, your SunTrust banks, your Truist, Wells Fargo, right? They have extensive selection of financial products, including loans, credit cards, and investments. So just think of all the things that the banks offer. Most banks have a lot of different types of ways that they offer loans for car loans, home loans, business loans, small dollar loans, large dollar loans. They have a lot of different credit card alternatives. They have a lot of different things that you can invest in. Some of them might even have an investment broker on site. The FDIC insures up to $250,000 for every consumer, every person that has money deposited in that bank. So if you have multiple accounts, multiple checking, saving accounts, each one is insured. So some people that have $1 million will open up 4 accounts and put $250 in each account so that their money is totally insured and it doesn't just stop at $250. ATMs, they have large networks. So the one positive about banks is they have a large network. Think of your Chases, they're everywhere. Bank of America is everywhere. So there are large networks of banks with their branches and ATMs all over the place. And then their online presence is very strong as well. So these are some of the key features of banks that are insured by the FDIC. So let's look at some of the pros. A wide range of products and services and resources. A lot of banks, especially the larger banks, we have regional banks, national banks, we have community banks. So a large range of their services and resources they have greater accessibility with many branches and ATMs. And the FDIC protection is a very, very strong, tried and true safety net. Now, some of the cons are that people feel like sometimes their fees are higher. They charge a lot of different fees. And so their fees are higher. They've got monthly fees, overdraft fees, transaction fees, wire transfer fees, cashier check fees, money order fees, so they have a lot of fees. And they're more focused on profitability than personalized service. Banks are a for-profit business. And so because they're for-profit, they are always looking to make a profit because why? their investors, their shareholders are looking to make a profit quarter over quarter. So let's look at the NCUA, insured credit unions. They are membership based. They're owned by their members. So if you have an account at a credit union, you own a part of the credit union. That means as a member, you have governing rights. You have voting rights. You can go to the shareholders meetings, the investor meetings. You have rights because you are part of the membership. Now, credit unions are also a nonprofit. So they operate to serve their members. They have a mission statement versus a business model. They have a mission statement that they work to fulfill, nonprofit, and they don't have shareholders. Their insurance is through the NCUA, and it insures up to $250,000 per consumer for whatever account type. So your money is also insured at the credit union. And they offer lower fees and better rates on loans and savings. So a lot of times, as a credit union, they have a community focus and they try to stay competitive, but they also like to keep their members happy. And so oftentimes they don't charge as much in fees. And sometimes you can find that their rates are maybe lower than financial institutions, than banks. So it's a good thing to compare the two. And so now we'll look at the pros and the cons. So the pros are lower fees and better interest rates of savings and loans. So that if you get a loan, you'll probably get a better rate. If you have a savings account, they might have better rates. They are member focused. Credit unions really like to take care of their members. Their customer service is great. They are really a strong believer on being customer service focused with their personalized customer service care. And decisions align with members' needs rather than for profits. So that's important. The cons are there are fewer physical branches and ATMs, and they have a limited range of financial products compared to larger banks. So that means that credit unions, the one you bank with, might be 30 miles away from you. It might not have but one branch in one city or one branch in one state. And they might have a limited amount of products compared to larger banks. And that's important because it depends on what it is that you need a financial institution for. What is your need? As consumers, we have to start looking at what is it that we need? What is it that we want? And not just today, but 5 years from today. What decisions are you going to be making in your life? For example, if I'm in my 20s and I know I might get married soon and want to buy a house, what kind of bank would I look for or credit union, and what type of loans would I need if I wanted to buy a house? Would I qualify for the types of loans that they offer at the credit union? Are they a little bit harder to qualify for? Are they a little easier to qualify for if I become a member there? Or what are the banks offering as far as mortgages? And who has down payment assistance? Do credit unions offer down payment assistance? Do banks offer down payment assistance? Do they have first-time home buyer products and services to help me buy my first home? Or if I'm looking at starting a business, does a credit union have business loans? Do the banks have the business loans? So I think as consumers, we have gotten away from really studying what type of bank it is that we want to go to. And instead we find the bank that's either closest to us, more convenient, somebody told us about, we see some commercials about. And in all honesty, every single bank has a different interest. You have agricultural banks and credit unions. You have banks that want to invest in technology and credit unions. You have credit unions and banks that want to have real estate as their focus. You have banks and credit unions that look at commercial business, that's their focus. Maybe some are more automotive centric. Maybe some are more startup centric. So it is really the consumer's responsibility to go to all the websites and kind of look at what do they offer. There's always an about us on bank pages and credit union pages where they talk about who they are. What do they do in the communities where they're at? What kinds of programs do they have? Do they work in the communities and offer like financial literacy? Do they give backpacks? Do they support the community? What type of programs do they have for lending? Do they only have one mortgage type, or do they have multiple different mortgage types so that when you get ready to buy a house, you have choices? And it's up to you. What type of credit do you have? What type of budgeting are you working with? So you have to think about what you need today and over the next 10 years, and then think about looking at different banks and credit unions online to see who aligns best with what you need for yourself and your family. So key similarities between the two. First, they both have government insurance. The FDIC and the NCUA. Both insure your money up to $250,000. They both provide checking and savings accounts, loans, and other similar products. Some credit unions might not have credit cards that come through their actual financial services, but they might be a vendor of a credit card. It's important to look at that because if they are a provider of a credit card, then that means your customer service for that credit card will not be necessarily at the credit union. It'll be at wherever that customer service is provided for that type of credit card, where most banks are the funder of their credit card. So always look and see and ask questions. Hey, you offer a credit card, or you offer a business credit card, or you offer these credit cards. Are you the issuer of the credit card, or are these credit cards issued through a different entity? And can I know who is that entity, and how do you guys provide customer service around those credit cards? Do I call you if I need to delay my payment, or do I have to call somewhere else? These are questions you need to ask. Even at the bank, ask the same questions. Ask those questions to find out how you can manage your payments. When things go wrong, you might have an outage, whatever emergencies come up, you want to know before you commit yourself to the products and services those banks or credit unions offer. Who is going to service me? How do I make my payments? Where will the payments be made to? Well, can I come into the bank if I don't have time to do it online? And you also want to feel comfortable enough that when you go to your credit union or your bank, that somebody's going to sit down and have time to talk to you. That's very important. They're both regulated by strict federal regulations, and they both aim to ensure consumer deposits and maintain trust, right? Banks are a for-profit business, so the shareholders are very important to the CEO and to the board of directors. The bank is a for-profit entity, meaning that they have to show profitability every single quarter or every single shareholder meeting. Credit unions, on the other hand, are a nonprofit. So they're not looking to have that big profitability margin quarter after quarter, and they don't have shareholders breathing down their backs, pushing them. Once you get a credit card there, or an auto loan there, or a mortgage loan there, or you open up a checking and savings account at a credit union, you are now a member of the credit union and you have ownership interest at that credit union. Banks typically have higher fees, more hidden charges. Always check your bank account every single morning before you do anything. As soon as you wake up, before you check social media, before you check your messages, check your bank account. They have a ton of fees. And sometimes those fees come in when you're least expecting it. You don't want your account to be overdrawn. So banks have higher fees, more hidden charges, and sometimes they have fees a little bit more often during the month, where credit unions have lower fees. They're member-friendly policies. So they create their policies thinking about consideration around the members of the bank, right? And their loan rates. So we're going to look at loan rates for banks. Banks usually have higher rates on loans and credit cards. Credit unions have lower interest rates for their members. Banks are accessible everywhere. They have great accessibility, and sometimes they have ATMs everywhere that they're not. So they have a global presence. They have presence outside of the country, all over the country, depending on the bank that you choose to bank with. Credit unions are limited. They have limited branches, and they're normally very local or very regional, not necessarily national. So these are things to consider. And again, it's up to you to interview, research, and just do a little bit of due diligence to figure out what's going to fit best with your lifestyle. Cost and fees. If the bank charges you too much of your hard-earned money to just bank there, that's something you need to think about, versus credit unions that have lower fees for their members. Interest rates and loans and savings account. Credit unions typically have lower interest rates. They charge less on their loans and their savings accounts, where banks have higher fees, higher rates on loans and savings accounts, higher interest rates. And then the customer service and community focus. If that's important to you, you want to consider, and you want to get to know the banker that you're thinking about banking with, and get to know the person at the credit union that you're thinking about over there. These are important things for your lifestyle because it's a relationship with the bank. It shouldn't be just something where your money is. You really need to know these people. Know the branch manager should know you, the manager at the credit union should know you, because when it comes time to making choices for your family, you want somebody at the bank to know who you are, to understand why you're making the financial decisions you're making, and to help you along the way and to offer suggestions. Because as a banker, I know that if my client comes in and they need something and they're not communicating it correctly, or they're saying they need one thing, but my conversations with them over the years, I know they're trying to get something else. I would go up to the teller, or I would go up to the business banker, or I would go up to whoever they're trying to talk to, or if they had a problem, they could call me and I could explain it to whoever they were trying to talk to about it. It's important to know your banker because we really are the internal advocates for you. And if you're about to ready to sell your house that you have and buy a new house, they understand that process. And if the lender doesn't know everything about you, but you've been having conversations in the bank all these years, that person could explain it to the lender. Hey, they need to do this and this. They're selling this house and they have this equity. I know they do, but they got to wait until they get the house sold and then they want to buy this new house. Like, we really advocate for our customers inside. Let them know what your budgeting is doing. If you got a new job, if you're making more money, if you want to save, it's important to build those relationships because listen, that's where your money is. And you want your money to do the best job that money can do. So it's important to touch base with the banker 2 or 3 times a year so they know you and they know what's going on and where you're trying to go. What is your financial strategy in case of government overhaul? If the government decides to dismantle the FDIC or the Federal Reserve, but we're going to do a separate video for the Federal Reserve. The current discussions about this new oversight agency remain speculative. So right now, there are thoughts around if the FDIC is dismantled and goes away, there are discussions about a new agencies that they're thinking about building. I'm going to do a separate video about that as well. And then emphasize staying informed about government plans. We are going to continue to watch this. Any changes that happen about the FDIC or any of the regulatory agencies is going to take time. I'm going to follow them and we're going to talk together. We are building a community of people that are very interested and involved in wanting to know what's happening with our financial institutions that house our money. So as this continues to be discussed at the government level, we are going to be discussing it at our level. So please continue to follow me, subscribe to this YouTube page, join my VIP private membership group, follow me on all the social medias. I'm going to be following this because if it happens also, I mean, it sounds scary, but it's also transformational. And it's like one of the biggest things that could happen in the history of the United States because things haven't happened like this since all of the regulatory agencies were created. The last one that was the newest one created was the CFPB. And then diversify your funds for better safety. So let's talk about that. So what do we mean by diversifying your funds? If you're feeling concerned right now, my suggestion to you is to keep some cash at home. 10% of what your monthly income is a good amount of cash to have at home. So for example, if you make $5,000 a month, have $500 at home in case of an emergency. This is just in case of emergency money. This is not bill money. This is not going out to eat money. This is money that you should be stacking every month and store it in a secure place like a fireproof safe. A fireproof safe is cool. I have my money in a different type of place stored, whatever works best for you. So also consider maintain 3 months income in a safe location. So if you can have 3 months of your income at home or in a safe location, like a bank deposit box, a home safe, or in an account that's liquid. What do we mean by an account that's liquid? When we say account that's liquid, we're saying if I go to that account to draw money out, I don't have to wait for transferring of it out of a 401k or out of some kind of pension fund or retirement fund. The money is actually there and I can pull it out same day I need to go get it. As a self-employed person, contracts and all that, they pay slow sometimes. So I have to keep money aside so that when it comes time to paying my bills, I have my money there whether my contract has paid me or not. So always have some money set to the side. So now, this is what I say, because I have an account in a credit union. And when I say I bought my car through my credit union, they offered the best rate for the financing of that automobile. So I bank with 3 entities and I have 5 accounts, right? So you want to have multiple accounts as far as I'm concerned. Never put all your eggs in one basket. It's good not to have all your money in one place. Don't make it unmanageable, right? But make sure you feel that if anything happens over here, you've got money over there, and vice versa. I also think it's good to have a bill paying account and a savings account and an investment account. Always have an emergency credit card. Have one credit card that you have that doesn't have a balance on it that you don't use, so that in case of emergency, you have a flat tire, you need to get a new tire. The furnace goes out, you need to get a furnace. You should have an emergency credit card that can cover the cost of some type of emergency. You could diversify your monies into things like gold, treasury bonds, digital assets, mutual funds, stocks. Diversify your money and put a little bit in each. And then diversify your money again into investments and keep some cash at home. Keep a large amount of cash somewhere in a liquid account. I'm going to be keeping an eye on this. You keep an eye on this. This is the information you need. I can't tell you to choose a bank or a credit union, but I can tell you, based on what your lifestyle is, these are the things that they do. So what is your plan, right? In the description section of this video, I have all the links listed that you can research all of the credit unions in this country, so that you can find the credit union. You can find a credit union anywhere and learn about them. I also have a link in there that'll show you all the banks. I have a link in there that teaches you more about the FDIC. I have a link in there that teaches you more about the NCUA. Let's do a quick recap. The 5 things you need to do in order to feel more comfortable about everything that's going on right now as far as the dismantling of the FDIC. First, write out your goals for your life for over the next 5 to 10 years to figure out what it is you're going to need from a financial institution. And then, using the links I provided in the description, look up different banks and credit unions in your area. I provided links that have a national list of all the banks, FDIC insured banks in the country, and all the NCUA credit unions in the country. Look at them up, and based on what you believe your goals are going to be over the next 5 to 10 years, whether it's buying a house, retirement, moving, anything, think about those things when you're looking at the credit unions and see which ones align best with the goals and objectives that you have for your life, your family, that you have for the next 5 to 10 years. Number 2, diversify your money. If you can, put money into a bank and a credit union, if that works for your lifestyle where you are. Diversify your money so that you have some money in one and some money in another one. Also, make sure that you're investing, and that's diversified as well. Invest in different things. You can invest in gold. You can invest in savings bonds. You can invest in mutual funds, stocks, digital currency. Number 3, take 10% of your monthly income and put it somewhere in your home and consider it petty cash that you're not going to use in case of emergency. Number 4, get an emergency credit card that has no balance on it that you can use in case of an emergency. And number 5, if you can, save up 3 to 6 months of your bill money, either in a fireproof safe, an account, a liquid account where you can actually get to the money, or in a safe deposit box. So those are the things. There's a ton of good information in the links that's in the description of this video. Check them out. And we're going to talk. The next video you need to watch is the Project 25's plan on dismantling the FDIC and what they suggest should be in place of it. So that's going to be the next video. I think that one's going to be pretty interesting too. See you over there. And if you want, please follow me on all social media, like, subscribe, and share this video. It's a really great way to support my channel and to help me grow. It's a free way to support my channel and help me grow. My name is Lisa Davis. I am the Trusted Banker, and I will see y'all later. Bye.